Good afternoon. It's Friday, March 17th. I'm George Corrali, and this is the Market Minute. Despite the banking chaos, it's possible the Fed will hike rates by 1/4 point next week, but it's now unlikely the Fed will hike rates by another 1/4 point at its May and June meetings. So the Fed has done it again. It's followed a long-term historical tightening cycle pattern, hiking rates until something breaks. To be fair, though, the hiking cycle usually exposes company-specific mismanagement. Like Warren Buffett says, only when the tide goes out do you discover who's been swimming naked. Silicon Valley Bank, Signature Bank, Credit Suisse, these banks' problems were of their own making. We don't think that these events will turn into a full-blown global credit crisis. There will be some fallout, no doubt. Shares of the regional banks and the big banks are under pressure, but we don't believe there is widespread contagion risk. The regulatory response by the Federal Reserve and the Swiss Central Bank has so far been swift and decisive. Another classic measure of banking strength is also suggesting that things are not getting out of hand, at least for now. The TED spread, the gap between the rate at which banks lend to each other, traditionally captured by LIBOR, the London interbank offer rate, and the equivalent Treasury bill yield. Let's take a look. The higher the spread, the greater the distrust between banks. There's no real evidence that confidence has broken down at present, and certainly nothing remotely comparable to the 2008 financial crisis. Inflation has peaked and will likely continue to fall in the months ahead. The Consumer Price Index, or CPI, came in lower than expected the other day. Here's a chart of inflation over the years. You can see that it now sits at 6%. It fell from 6.4 to 6% in February. This was the 8th consecutive decline in the year-over-year rate of inflation and the lowest level since September 2021. Bank failures are deflationary, and the Fed is sucking liquidity out of the financial system with its interest rate hikes. We had a whiff of deflation in 2009. The Fed does not want a repeat of that situation, so rate hikes are coming to an end. Let's talk about M1 and M2 money supply for a minute. M1 money supply includes those monies that are very liquid, such as cash, demand deposits, and traveler's checks. M2 money supply is less liquid in nature and includes M1 plus savings and time deposits, certificates of deposits, and money market funds. The Federal Reserve publishes M1 and M2 money supply data every Thursday at 4:30 p.m. Here's a chart of the M2 money supply. M2 is a critical factor in forecasting inflation. The Fed's dual mandate is to balance unemployment and inflation. One of the ways it does this is by manipulation of the M2 money supply. The M2 numbers provide important insights into the direction, extremity, and efficacy of central bank policy. The Fed goosed M2 money supply and it exploded during the pandemic, rising above its long-term trend line and correctly predicting that we would get inflation. M2 growth is now plummeting. Over the last 7 months, the money supply has actually contracted by 1.1%. That's almost unprecedented. Inflation should continue to fall rapidly. Let's take a look at the Fear and Greed Index. It's registered a reading of 17 on Wednesday and is pointing to extreme fear. 1 month ago, it was at 71. It could go lower yet, but we've now entered the opportunity zone. Every big market sell-off forces the gauge under 25. Whenever this happens, you've got to switch to a more optimistic thought pattern and start putting together a list of securities you're interested in purchasing. Here's a chart of the Taildex Index. It tracks the demand for protection against a stock market crash. You can see that demand peaked as the stock market bottomed in October. We just exceeded those October demand figures. Look, as far as this bear market goes, we're almost 16 months into it. We're closer to its end than to its beginning. Here's a chart of the major bear markets going back to the 1960s. There are only 4 instances of longer bear markets than the one we're currently experiencing over the last 60 years. If we didn't bottom during October's plunge and we can't hold 3,800 on the S&P 500, then we likely retest the October low at 3,500. It's not uncommon for the S&P 500 to rally before going back down to test those old lows. So if we don't hold 3,500, then maybe one more capitulatory or throw in the towel sell-off before we reach the bear market bottom. Any larger sell-off brings our Roth conversion strategy into play. Bear markets represent the best environment to make an IRA to Roth conversion. The more negative the equity losses are, the more attractive the conversion becomes. You've got to stick with your game plan. As a bear market progresses, it can wear you down. Keep your perspective. Try to turn any bear market despondency you may feel into a more optimistic outlook, knowing this bear market is nearing its end. Bear markets have historically been the best times to buy assets. A new bull market is coming. Will you be ready? If you should have any questions about anything we've discussed today, please don't hesitate to contact us. And if you think this type of information would be beneficial to anyone you know, please share this video with them. Thanks for tuning into the Market Minute. I'm George Corrali. We'll see you back here soon.